If you want to build wealth through real estate, you need to buy property. That is a foundational belief driving every conversation about real estate investing. Every course sells it. Every podcast episode builds toward it. Every success story begins with the moment someone finally closed on their first deal. Buy the property. Build the equity. Collect the rent. Repeat. The logic feels unshakable. And for decades, it largely was. Real estate created more millionaires than almost any other asset class in American history. The people preaching direct ownership are not fabricating results. The wealth is real. The strategy is legitimate. But they are describing a version of real estate investing built for a market that no longer exists in 2026. Rising interest rates, compressed cap rates, record high entry prices, and historically unfavorable rent-to-price ratios in most major markets have quietly broken the math that made direct ownership the obvious first move for a $30,000 starting position. The strategy didn't fail. The conditions changed. And in 2026, there is a smarter first move. If content like this interests you, please hit the like and subscribe button so you don't miss our next video. But nobody ever asked the obvious question. If direct property ownership is the correct first move for a $30,000 starting position in 2026, if buying a rental property with that capital produces the wealth outcomes the courses promise, then why are the overwhelming majority of first-time real estate investors who entered the market in the last 3 years reporting negative cash flow, unexpected capital calls, and returns that trail basic index fund performance by a measurable margin? Not because they chose bad properties. Not because they failed to educate themselves. Because the entry math at current prices, current rates, and current rent levels simply does not produce the cash flow numbers that made direct ownership the obvious move a decade ago. The question nobody asked before writing the $30,000 check is not which property should I buy. It is whether buying a property right now is actually the highest return deployment of the specific capital, or whether that assumption is inherited from a market environment that no longer exists. That question changes everything that follows. Here is the actual data. The average cap rate on residential rental properties in the top 50 U.S. markets currently sits between 4.5% and 5.8%. The average 30-year mortgage rate in 2026 remains above 6.5%. When your borrowing cost exceeds your property yield, the math produces negative leverage, meaning debt is actively working against your returns rather than amplifying them. On a $30,000 down payment at current entry prices, the average first rental property in a mid-tier market requires a mortgage between $150,000 and $220,000. At current rates, monthly debt service alone consumes between 85% and 110% of projected rental income in most analyzed markets, before maintenance, vacancy, insurance, or property management costs touch a single dollar. The average first-time real estate investor in this environment is not building wealth through cash flow. They are subsidizing a property monthly while hoping appreciation covers a gap. Hope is not a return. Negative cash flow is not a wealth-building strategy. It is a liability dressed in the language of an asset, and $30,000 deployed into it in 2026 produces a fundamentally different outcome than the same $30,000 deployed a decade ago under conditions that actually supported the math. So why does everyone keep telling first-time investors to buy property when the entry math is this compromised? Because the real estate education industry was built in a different market and has no financial incentive to update its core premise. The courses, the coaching programs, the masterclasses, the weekend seminars, the overwhelming majority were developed, tested, and marketed during a decade of low interest rates, rising rents, and entry prices that made cash flow positive deals accessible at relatively modest down payments. That environment produced real results. The testimonials are legitimate. The success stories happened. But the curriculum never updated when the market did. There's also a structural incentive problem nobody discusses openly. Real estate educators, brokers, lenders, and property management companies all profit from transactions. Every first-time investor who buys a property generates fees, commissions, and ongoing revenue for an ecosystem built entirely around the act of purchasing. Telling that investor to wait, reposition, or deploy capital differently generates nothing for that ecosystem. The myth persists because updating it would cost the people selling it too much money. Your market conditions are not their marketing problem. Here's what actually builds real estate wealth in 2026. Starting from a $30,000 position, the real mechanism is not ownership, it is exposure. Specifically, the ability to participate in real estate's long-term return profile without absorbing the negative leverage, illiquidity, and capital-intensive maintenance obligations of direct ownership at current entry prices. Real estate investment trusts, REITs, provide that exposure. Publicly traded REITs deliver returns historically averaging 11.4% annually over the last 25 years. They are liquid, diversified across property types and geographies, require zero property management, carry no maintenance liability, and are accessible with a $30,000 starting position without a mortgage application, closing costs, or negative cash flow. The $30,000 deployed into a diversified RIT portfolio today begins compounding immediately. No vacancy risk. No tenant calls at 11 p.m. No capital call when the roof fails. Here is the mechanism that matters most. REITs allow a $30,000 position to remain fully invested and compounding, while you simultaneously build the market knowledge, local relationships, and capital reserves that make direct ownership genuinely profitable when conditions support the math again. Exposure now. Ownership when the numbers work. That sequence is the real mechanism. Here is a pattern that repeats among first-time real estate investors with remarkable consistency. Someone accumulates $30,000. They spend 6 to 12 months educating themselves. Podcasts, books, YouTube channels, maybe a course. They analyze markets, study neighborhoods, run numbers on dozens of properties. The preparation is genuine and thorough. Then they buy, not because the numbers are excellent, because waiting feels like falling behind, because every piece of content they consumed was pointing toward the same conclusion, because the entire education ecosystem they built their knowledge inside was structured around the inevitability of the purchase as the correct next move. 12 months later, the property is cash flow negative. The vacancy they did not model for arrived in month 8. The HVAC replacement they did not budget for arrived in month 11. The $30,000 down payment is now a $30,000 down payment plus $7,000 in additional capital deployed to keep the asset operational. The mistake is not buying real estate. The mistake is buying at the wrong point in the rate and price cycle because the content they consume never acknowledge that timing the entry conditions matters as much as selecting the right property. Patient capital compounds. Impatient capital subsidizes assets that are not yet ready to perform. Here is the exact sequence for deploying $30,000 into real estate intelligently in 2026. Step 1. Allocate $20,000 into a diversified RIT index fund immediately. Vanguard Real Estate ETF, Schwab US RIT ETF, or equivalent. Low expense ratio. Instant diversification across hundreds of properties and property types. This capital begins compounding in real estate returns today, without a mortgage, without negative cash flow, without a single maintenance obligation. Step 2. Deploy $7,000 into a high-yield savings account designated exclusively as your direct ownership acquisition fund. Automate a monthly contribution into it. This is not an emergency fund. It is a capital reserve that will make your eventual direct ownership entry clean, conservative, and cash flow positive from closing day. Step 3. Spend the remaining $3,000 on genuine market education, not a course teaching strategies built for 2015 market conditions, local market data subscriptions, property analysis tools, and direct relationships with investor-focused agents in your target market who can alert you when entry conditions improve. This sequence keeps your capital working, your knowledge compounding, and your optionality intact. So when the direct ownership math works again, you enter from a position of strength rather than impatience. Here is the honest timeline, specific, unsentimental, and worth understanding completely. Current market forecasts from multiple independent real estate research firms project meaningful cap rate expansion and price correction in residential investment properties across most major U.S. markets within 18 to 36 months, driven by sustained rate pressure, insurance cost increases, and motivated seller inventory building in over-leveraged landlord portfolios. That window is not guaranteed, but it is calculable. And $30,000 sitting in a REIT index fund during that 24-month period compounding at historical average returns, arrives at a direct ownership entry point worth approximately $33,600 to $36,000. More capital, better entry conditions, stronger negotiating position. The investor who waited intelligently enters with more money into a more favorable market. The investor who bought immediately in 2026 enters the same improved market, still subsidizing a cash flow negative property they cannot easily exit. Patience here is not passivity. It is the highest returning move available with $30,000 in real estate right now. You did not miss real estate. You arrived at a moment that rewards a smarter sequence over the obvious one. If this reframed your 2026 real estate strategy, subscribe. Because every week we cover financial moves that actually match the market you are operating in.